Welcome back to the deep dive. Today, we're really digging into something significant, a story that honestly says a lot about where institutional crypto might be heading. We're talking about Anthony Scaramucci, the Wall Street name, founder of SkyBridge Capital, and he's backing a massive raise for Avalanche, for AVX. We're talking $500 million. $550 million, actually. This isn't just, another investment. It feels much more like a strategic push, a capital injection that could really shake up the layer one blockchain space. So we're not just looking at the number, big as it is. We need to figure out why Avalanche, why this much money, and what's the signal here for the rest of crypto, especially for those projects trying to get traction with traditional finance.
Exactly. Our mission today really is get past the headline figure. We need to analyze what this $550 million Avalanche Treasury initiative actually means. What's telling us about institutional confidence in these faster, more scalable alternatives to Ethereum? And maybe more importantly, we need to look at the plan. How is this war chest basically going to fuel growth? In DeFi, in GameFi, and that really critical area, real world asset tokenization. Because it doesn't just affect AVX, it sort of sets a new benchmark for how these layer one chains need to fund themselves if they want to compete seriously long term.
Absolutely. It feels like Scaramucci through SkyBridge is basically saying, okay, institutional money isn't just watching anymore. They're picking a horse in this layer one race. And the fallout from that, well, if you hold AVX or build on it or compete against it, it's pretty profound. Now, before we really get into the nitty-gritty of how this $550 million could shift the layer one landscape, we just wanted to quickly ask for your support. If you find this kind of deep dive valuable, and we know you do, hitting that subscribe button, liking the content, maybe dropping a comment with your take on this huge AVAX move, it really helps us out a lot. It helps other people find the analysis, helps the algorithm notice us, and lets us keep putting the resources into making quality crypto analysis like this. So we really appreciate that support. Okay, so let's unpack this, starting with the core facts. And they're pretty startling, not just the dollar amount, but who's behind it.
Right. The core fact is the commitment. Anthony Scaramucci, SkyBridge Capital founder, he's the big institutional name backing this Avalanche Treasury initiative. And the target is $550 million. Specifically to boost the Avalanche ecosystem, its long-term growth, its development.
And that's where Scaramucci himself comes in. It's not just the money, is it? It's the brand lift that comes with him. It brings the significant Wall Street credibility to AVAX. I mean, when a traditional finance figure like him, someone known for navigating, complex markets and regulations, puts down $500 million, that sends a powerful message. It suggests maybe that the institutional due diligence is done, potentially making it easier for other, more hesitant institutions to follow.
That validation, I think that's the real currency here. It's not just the amount of money, but the kind of money, the institutional capital. This move signals a pretty profound renewed confidence in these alt layer one blockchains. It suggests the smart institutional money is actively looking for high growth, high scalability plays beyond just Ethereum. For you, the learner, this backing fundamentally changes how AVAX is perceived in established finance circles. It shifts it from maybe a high-risk tech play to a credible, well-capitalized alternative.
Okay, but let's play devil's advocate for a second. Scaramucci, he's definitely connected, but he's also been linked to some, shall we say, volatile crypto ventures, some bold bets in the past. Does his backing definitely bring credibility? Or could it also bring a kind of amplified hype, maybe even volatility that might actually scare off the more cautious institutional types?
That's a fair question. It needs a bit of nuance. Well, he's certainly, enthusiastic, maybe even maximal sometimes. His involvement here through SkyBridge points to a structured, large-scale capital deployment. That's different from just personal speculation. Credibility here, I think, means two things. First, access. Access to other pools of institutional money. Second, legitimacy in those legacy finance circles. They see him as one of them. And the scale, $550 million. It's so large, it kind of implies a long-term strategic bet, not just a quick trade. That helps lessen some of those volatility worries.
Right, let's stick with that scale then. $550 million, that's not your typical VC round. What does a treasury this size immediately give Avalanche?
It gives them a massive advantage, a real war chest. A raise like this provides immediate, pretty much unparalleled ecosystem resilience. You know how crypto markets are, sudden downturns, long bear phases. This funding means development teams, core researchers, the essential services on Avalanche. They can operate with stability for years. It creates this highly attractive growth runway. So if you're a developer thinking of moving to AVX, you know grants and funding probably won't just vanish if the market turns sour.
And the timing feels deliberate, too. We just saw Solana have that incredible run, attracting huge institutional and retail interest. It sort of became the alternative L1 success story of the last cycle. So by locking in this massive funding now, Avalanche seems to be positioning itself as the next serious contender, right?
Precisely. This capital injection is like a declaration of intent. It moves AVX from being just a strong competitor to being financially positioned to really challenge the market leaders. What's fascinating, I think, is that it suggests institutions are now comfortable enough with the tech behind these Alt L1s, specifically the speed, the finality, that they're willing to put up the huge budgets needed for them to scale globally. It's confidence in the tech combined with a play for market share.
Okay, that sets up the next question perfectly. How will the money actually be used? I mean, if the goal is market dominance, they need to spend smart, not just big. Let's look at Avalanche's core tech and this deployment blueprint.
So Avalanche's value proposition really centers on its consensus mechanism and its unique architecture, especially the subnets. Avalanche pitches itself as the high-speed, highly customizable alternative to Ethereum. The main problems they're trying to solve are offering super fast transaction finality and keeping transaction costs low even when the network is busy. The funding is meant to amplify that tech advantage by attracting users who really need that high-performance think, institutional DeFi or big gaming platforms.
So the $550 million deployment plan, the sources suggest it's pretty strategic, covering 4 different but crucial areas. That diversification seems key. Let's get into the specifics. What will this money actually buy in terms of development?
Yeah, it looks like they're targeting the future growth areas for Web3, going beyond just, simple token swaps. First, decentralized finance, DeFi, that's still the foundation. Funding here will likely focus on big liquidity incentives and security audits. They probably won't just offer basic grants. They'll likely target established DeFi protocols on other chains, offering massive multi-year incentives to basically get them to move their entire user base and TVL over to Avalanche. It's about capturing liquidity at scale.
Okay, so pulling existing DeFi over. What's next?
Second, GameFi or gaming infrastructure. This is where Avalanche's tech potentially really shines. Gaming needs instant, high-volume transactions, low latency. So the Treasury will fund specific game studios, developer tools, but also, and this is critical, the deployment of bespoke gaming subnets. These are basically dedicated layer 2s using AVAX security, but offering customized environments, cheap gas, maybe specific compliance features that major gaming studios need. This could allow millions of users without clogging the main network.
That focus on subnets seems really strategic, especially carrying over into the third area, real-world assets.
Absolutely. The third focus area is real-world assets, RWAs, tokenizing things like institutional bonds, private credit, real estate. Everyone agrees that's how trillions from traditional finance could come onto the blockchain. But institutional RWAs need specific things: regulatory compliance, permission access, predictable performance. So the $550 million will likely fund the creation of institutional-grade compliant subnets, sometimes called app chains, where only vetted institutions can operate. This capital will help attract the legal and regulatory experts needed to make these bespoke chains work within existing financial rules. This is a huge multi-year effort they're funding.
And the fourth area, investing in non-fungible token NFT infrastructure.
Right. Well, maybe it sounds less flashy than RWAs or GameFi, funding NFT infrastructure marketplaces, minting tools, creator platforms. It's vital for capturing creator attention. A slice of the funds will likely go towards creator incentives and making NFT transactions faster and cheaper, giving a smooth experience that can compete with places like Polygon or Ethereum's Layer 2s.
That variety really underscores the long-term vision. It's not just a bet on one thing. But like you said earlier, money isn't everything. You need the people. The goal seems to be sparking a builder migration.
Yeah, the cash is definitely meant to be a huge magnet for talent. Avalanche can now offer grant programs that aren't just large, but also really competitive compared to other chains. Think less like simple grants and more like venture-style funding, maybe offering technical help, access to institutional networks like Scaramucci's, and favorable token incentives. They're trying to create an environment that's almost irresistible, designed to pull top developers and major projects away from, say, Ethereum's congestion, or maybe some of the operational hiccups seen on other fast chains recently.
So it's essentially a targeted talent raid, but backed by very serious money.
It is. And the bigger picture here, the broader implication, is that this could set a blueprint. If Avalanche pulls this off, if they deploy the $550 million effectively and show real growth in TVL and developers,
It fundamentally changes the game for all layer ones. It establishes that having a massive, resilient treasury isn't just nice to have. It's basically the cost of entry for playing in the L1 big leagues long term. This could become the standard playbook for sustainable ecosystem growth.
Okay, let's pivot then to Section 3. Let's talk immediate market impact. For you, the investor, the trader, maybe someone already holding AVX, what are the direct financial implications of this big institutional commitment?
Well, the main takeaway should be a significant strengthening of the asset's fundamentals. That could translate into better long-term price support. When a network secures this level of funding, it just implies much greater confidence, greater financial stability. If the Treasury deployment works as planned, brings in more dApps, more users, boosts TVL that directly increases the utility and demand for the AVX token itself, that should provide a stronger, more resilient price floor over the long run. It potentially reduces the pure speculative risk and bumps up the utility value.
But crypto markets being crypto markets, they run on sentiment too, and the short-term noise around an announcement this big can be pretty wild.
Oh, absolutely. Traders are going to be laser-focused on short-term speculation, specifically tied to deployment milestones. Not just the initial announcement, but what comes next. The market will likely react strongly to specific news drops. Things like AVAX Treasury funds $150 million RWA subnet with a major bank, or AVAX launches massive grant program for 50 GameFi studios. Each concrete, successful milestone announcement could act as a catalyst, driving positive sentiment and maybe short bursts in price.
And this whole thing is playing out against the backdrop of the L1 wars. This $550 million isn't just development money, it's a competitive weapon. It's definitely an aggressive move. Funding at this level is designed to pull liquidity and market share away from rivals. For institutions looking at different chains, this funding offers a kind of proof of concept, a sign of reliability. Why pick a smaller, less capitalized chain for your big multi-year project when Avalanche has shown it has both the tech and the deep pockets? It helps separate AVX from the crowd of smaller chains and pushes it more firmly into that top tier with Ethereum and the very well-funded Solana. The institutional message seems clear. They're backing what they see as the most structurally sound alternative.
Okay, so for the listener, for you trying to critically evaluate this whole play, what specific metrics should you be tracking? How do you know if this bet is actually working out? We need a clear toolkit here.
Right. We can break it down into three main categories of metrics. These come directly from the Treasury's goals, and you really need to watch them closely. First, you have to track the relationship between market sentiment and Treasury action. Specifically, look at the correlation between the AVAX token price and these deployment announcements. If Avalanche announces a big partnership or a huge grant program and the price barely moves or jumps and then falls right back, that might signal the market thinks the strategy is ineffective, maybe just unsustainable hype. On the flip side, a sustained positive correlation between news and price is usually a sign of fundamental health.
Okay, sentiment correlation. What's number 2?
The second one is maybe the most tangible measure of adoption. Total value locked, TVL. You absolutely must monitor the TVL on Avalanche. And crucially, compare its growth rate directly to its main competitors, Ethereum, Solana, maybe some of the newer L1s. If this $550 million is genuinely attracting capital, Avalanche's TVL growth should noticeably accelerate and ideally outperform competitors over, say, the next 18 months. We should see significant liquidity pools forming, especially within those new DeFi and RWA subnets they're funding.
Got it. TVL growth relative to competitors. And the third metric circles back to that builder migration idea. It's about the developers, the people actually building things.
Precisely. The ultimate proof of a successful treasury is on-chain developer activity. We need to see a clear acceleration in things like the number of new smart contracts being deployed, the volume of code commits to projects on Avalanche, and just the sheer rate of new apps launching. The money is supposed to attract builders. If the number of active devs and projects just stays flat, then the strategy hasn't really worked, regardless of Scaramucci's name recognition. And this activity needs to be measured not just overall, but specifically in those target growth areas like GameFi and the RWA subnets.
That quantitative framework is super helpful. But as we all know in crypto, history has seen plenty of massive treasury announcements that just fizzled out, or worse. So here's where it gets really interesting. We need to put this $550 million bet into historical context.
Yeah, when you're looking at a massive treasury play like this, there are definitely some important historical examples, both good and bad, that Avalanche is almost certainly looking at. Let's start with the positive benchmarks, the success stories. Think about Solana. Its incredible growth wasn't just about tech. It was heavily fueled by huge venture backing from firms like CoinGecko, A16's ADS. That capital let them run enormous, sustained incentive programs, basically paying developers and users to build on Solana and move over. Solana kind of proved that, especially early on in the L1 race. Having a big, somewhat centralized fund for ecosystem incentives can be a powerful, maybe even necessary way to kickstart network effects and grab dominance.
Okay, so Solana is the model for using big money for aggressive incentives. Then you mentioned Polygon. They offer a model more focused on strategic deployment, right? Targeting established traditional companies.
It's exactly. Polygon's success is really a masterclass in using Treasury funds to bridge the gap to Web 2. They didn't just hand Nike or Starbucks a check. They often used their treasury to fund the complex technical work needed for those integrations. That could involve setting up dedicated Polygon supernets, their version of subnets tailored to meet the specific security, compliance, and performance needs of a huge corporate partner. Their funds essentially paid for the specialized dev teams and maybe even initial capital guarantees required to make these tricky integrations happen, landing major brands and creating real-world uses.
And the third success story, the one focused more on long-term resilience. That's the Ethereum Foundation.
All right, the Ethereum Foundation provides maybe the most enduring model, but it's quite different. Their approach was never really about chasing market cap or short-term hype. Their treasury was almost entirely dedicated to funding long-term research and development, R&D, core protocol upgrades, like the big shift to proof of stake. That relentless focus on fundamental stability, security, and decentralized resilience, all funded by a dedicated foundation, is what cemented Ethereum's reputation as the most technologically sound and decentralized L1. It built this massive institutional moat that sheer capital alone can't easily overcome.
So those are the high bars. Solana for incentives, Polygon for corporate integration, Ethereum for deep R&D. But Avalanche also needs to pay very close attention to the cautionary tales, the failures.
Oh, absolutely. And the biggest cautionary tale, the one that every L1 founder probably studies nightmares about, is the collapse of Terra's Luna Foundation Guard, LFG. LFG also controlled the treasury worth billions, mostly intended to defend the UST stablecoin's peg. The failure there was twofold: governance and strategic purpose. The treasury was highly centralized, and it was deployed, arguably recklessly, for market defense and speculation, instead of being used for diversified organic ecosystem growth. When that market defense inevitably failed, the centralized control structure meant investor confidence just evaporated overnight, leading to a total catastrophic network failure.
So the lesson from Terra is pretty stark. The size of your treasury doesn't matter if the strategy behind it or the governance managing it is fundamentally flawed. It's an amplifier, it can amplify success, but it can also accelerate failure dramatically if misused.
Precisely. And this raises the absolutely critical question for Avalanche's leadership, the one that we as learners really need to watch. What is the governance structure for this $550 million AVX treasury? Is it managed solely by the Avalanche Foundation? Is it going to be a decentralized DAO? Or is it some kind of centralized committee involving SkyBridge and other institutions? Because the degree of centralization directly impacts how quickly and, frankly, how responsibly they can deploy these funds. And crucially, how they balance those competing priorities we talked about. Will they prioritize the slow, steady R&D like Ethereum? Will they go for aggressive corporate deals and specialized subnets like Polygon? Or will they get tempted into unsustainable yield farming or market defense, repeating Terra's mistakes? The governance model is the risk profile here.
That's a vital point to reflect on. How they manage and deploy this money will really define Avalanche's trajectory for the next few years, which leads us nicely into our final section, the specific risks, the challenges, the potential bumps in the road for this $500 million plan.
Well, the first, most immediate challenge is just execution and market timing. Raising this kind of money is hard enough, but deploying it effectively without causing market distortions or just wasting it, that's even harder. And in the crypto market, which is inherently volatile, keeping that institutional momentum going requires near flawless execution and really constant, transparent communication. Any significant delays in deployment or funding projects that just don't get traction could quickly turn that initial excitement into skepticism among institutions.
And it's not like Avalanche has the field to itself. They've secured the capital, yes, but they're still fighting tooth and nail for developer attention and institutional mindshare.
The competition is absolutely relentless.
Avalanche is battling for mind share and liquidity, not just against the established giants, Ethereum and Solana, but also against newer, often very well-funded L1s and L2s that have learned from all these historical examples. You've got contenders like Near Protocol with its clear sharding roadmap, or Sui, which launched with huge VC backing and a novel programming model. These chains are also throwing multi-million-dollar grants around. Avalanche has to consistently outcompete them on incentives and prove that its subnet architecture offers a genuinely better path for institutional adoption.
And maybe the biggest risk of all is simply failing to live up to the massive expectations set by this funding round, potentially leading to institutional capital flight.
That's the core risk, and it ties directly back to where the money's coming from. Reliance on performance. Scaramucci's involvement generated a huge amount of institutional goodwill and positive buzz. But institutional capital is ultimately very results-oriented. If there's mismanagement, if funds go into projects that fizzle out, or if they fail to deliver on those key metrics we discussed, TVL growth, developer activity, that initial institutional trust will erode. If the narrative shifts from well-funded future leader to overhyped disappointment, that confidence could retreat very quickly, creating a really nasty negative feedback loop for the AVAX ecosystem and its token price. That's the difference between building a self-sustaining ecosystem and one just temporarily propped up by grant money.
Okay, so to bring this whole deep dive together, let's quickly recap the ultimate signs of success. What should you be watching over the long term to judge whether this massive bet actually paid off?
I think we need to monitor three fundamental things, connecting the dots between the capital, the competition, and actual adoption. First, keep an eye on the transparent governance and the ongoing growth of the Treasury itself. Look beyond the initial $550 million. Are they attracting further inflows? Is the Treasury structured to potentially generate revenue from the ecosystem it's funding? Is the deployment process clear and avoiding those centralized pitfalls we saw with LFG? Second, watch for specific, verifiable institutional inflows to Alt L1s, particularly AVX. We need concrete evidence of major traditional finance players choosing Avalanche for significant RWA or DeFi projects, and compare Avalanche's success rate here directly against Solana, Near, and Sui, who is actually landing the big institutional deals. And third, maybe most importantly, assess the overall sustained impact on total value logged TVL across the entire Avalanche ecosystem. Pay special attention to the TVL locked within those subnets dedicated to high-value institutional use cases and GameFi.
If that TVL growth is strong, sustained, and outpaces rivals, it suggests the subnet strategy and the $550 million war chest are actually working as intended.
That wraps it up perfectly. This $550 million AVX treasury, it's clearly more than just a big check. It's a statement from institutional finance, a statement that they're ready to bet serious capital on high-speed Layer 1 alternatives, and maybe that they see something like the subnet model as a viable way forward for scalable institutional blockchain adoption. It definitely sets an aggressive, maybe even necessary new standard for how decentralized ecosystems need to fund themselves now.
And the final provocative thought, building on that huge institutional push, has to be this. Can Scaramucci's very potent, very centralized Wall Street confidence and capital actually translate into the kind of long-term, sustainable, decentralized success that altcoins ultimately need to thrive? Or is funding at this scale just amplified hype? Destined perhaps to face the same brutal volatility as the rest of the market once the initial excitement inevitably fades? I think the effectiveness and the transparency of the governance behind that $550 million is what will ultimately determine the answer.
It's a crucial question indeed, demanding careful observation as this plays out. If you want to track those metrics we talked about, TVL, developer activity, those institutional partnerships, we definitely encourage you to check out the official Avalanche blog and look at detailed reports from places like Messari to monitor how the Treasury's funds are actually being deployed. That's all the time we have for today's deep dive. Thanks so much for joining us, and we'll see you next time.